Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Now, this slide here is a little bit more telltale than I'm letting on. Implied volatility does rise and it does fall. Happens all the time. And sometimes it rises and falls a lot. Sometimes it rises and falls so much that it's the most important variable in your whole equation. Now, in volatile periods like we've seen, oh boy, we've been seeing volatility for a while now. When implied volatility rises and falls a whole bunch, it can actually matter more than directional changes in the underlying. It can be hugely important. So the question is, and this is kind of what we're leading up to, and once we get through this segment, we can really kind of put it all together and talk about here's how you actually use this stuff. But, you know, I can't give you an easy explanation. We've got to go through, you know, all this, and you really need to understand it in order to be able to use it. So let's say we have a currency price, you know, it's trading at $60. There's about 30 days till expiration. And let's say, you know, the price of the currency happens to not change at all. But later today, implied volatility rises from 12 to 13. We would see the price of the, you know, some given option, 40 call, say. Actually, that would be a typo. It should be the 60 call. Rise from $1 to 105. And then as implied volatility rises yet another point, we would see the price of the 60 call rise from 105 to 110. Now, I've already kind of subjectively told you that as implied volatility rises, option prices rises. And that's what we're seeing here. And likewise, if implied volatility were to fall from 12 to 11, we'd see the value of the 60 call fall from $1 to 95. And, you know, subsequently, as implied volatility falls another point from 11 to 10, we'd see it fall from 95 to 90. This is what I've already explained. But you notice each time it rose a point, we saw the value of, each time implied volatility rose a point, we saw the value of the option rise a nickel. And each time implied volatility fell, we saw implied volatility fall by a nickel. Now, in this example, it happens to be a nickel every time. With a different currency, different number of days till expiration or something, it could be something other than a nickel. But it's always a very specific number. And it's important to understand what that number is because you're not really trading implied volatility. You can't call up your broker and say, hey, I made 5 implied volatility points yesterday. Can you send me a check for 5 implied volatility points? No, it doesn't work that way. You're trading option value, and that does equate to real money. So implied volatility is the figure that changes, that affects your option value, but you need to understand how those changes in implied volatility translate into changes in option value. And here's how you do it, with Vega. Vega is one of the Greeks. Now, technically it's not actually a Greek letter, but some option trader early on decided that that would be the best name for a Greek that measures volatility, presumably because it's alliterative, as in they both start with a V. So we use Vega as such. Vega is the rate of change of an option value relative to a change in implied volatility. It's measured in dollars and cents. So if you were to look at an option chain and see a Vega of 0.05, that means 5 cents. That means every 1 full point that implied volatility changes, your option price changes by a nickel. Okay, now we've kind of come full circle here. We understand realized volatility, we understand implied volatility, and we understand how that translates into real dollars and cents in our pocket. Now, we need to understand, how does this work? How do I forecast it? How do I make smart opinions on it? Because I know that if implied volatility changes, I could make or lose money, but how do I know if it's going to change? Well, here's how. You look at volatility charts. Just kind of like stock charts, there's a starting point. Well, stock charts are a starting point for volatility analysis. You look at just a regular old stock chart, or in this case, a currency chart. And, you might see big price swings, but in order to quantify those, we use volatility figures. And so to accurately measure changes in volatility and make intelligent predictions about future volatility, we don't look at a chart of the currency, we look at a volatility chart. It's a way to analyze volatility in much the same way that a price chart enables you to analyze a currency. You can get these charts from your broker, from other sources online, from fxoptions.com, or really a ton of sources for free. They're becoming more ubiquitous. They're not quite as ubiquitous as, price charts, but you see them more and more because option trading is on the rise, and because if you're going to trade options, you absolutely have to look at a volatility chart every single time, or else you could be getting into a trade at a lousy volatility level, putting yourself at a tremendous disadvantage. So we're going to use these charts to analyze both the realized and implied volatility over a certain period of time, probably like 6 months or a year, to make smart decisions about future volatility.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.